Hello, everyone. Welcome to the penultimate talk in our series on financial risk, innovation, and inclusion in a post-COVID world. I'd like to welcome you all on behalf of CAFIN and UC Investments. And our speaker today is distinguished financial economist Leora Klapper. She's had a career in the private sector, in policymaking, and now at the World Bank. And I think one thing in particular to note is that she's one of the founders of a very important global database on financial inclusion. I think COVID has certainly exposed all kinds of inequalities in the world. And one of the most important of those is I think, gender inequalities in financial inclusion. And Leora, Dr. Klapper will be talking about that today. So without further ado, I will hand over to Dr. Klapper to speak on measuring financial inclusion and the fintech revolution, using data to design better policy for women. Thank you, Leora.
Thank you. Thanks for the introduction. I'm going to present to you some exciting data on the importance of reaching gender parity and financial inclusion, and talk a little bit about why COVID-19 has really brought urgency to this agenda. This is background. About 10 years ago, there was increasing interest in consumer finance. We had data from the IMF that was collected directly from banks, from the providers, suppliers of financial services, on the number of accounts, for example. It was a black box of data. We didn't know, for example, how many poor adults had accounts compared to rich adults, rural adults versus urban, old versus poor. And we certainly didn't know that in Turkey, for example, men are more than 30 percentage points more likely than women to have an account. So with funding from the Bill and Melinda Gates Foundation and in collaboration with Gallup, we went out and asked over 150,000 adults around the world, over 140 countries, about their financial decisions. And we asked this in 2011, 2014, and 2017. And so what we've seen is financial inclusion is on the rise globally. This third edition in 2017 shows that about 1.2 billion adults have gotten an account since 2011, including over 500 million since 2014. Between 2014 and 2017, the percent of adults who have an account ownership, rose globally to about 70%, including 63% of adults in developing countries now have access to a bank or a mobile money account. We're really seeing that digital technology is driving access to both the access to, and especially the use of financial services. In sub-Saharan Africa, for example, mobile money account ownership rose from 12% in 2014 to 21% in 2017. And what we really saw was the surge in mobile money usage spreading from West Africa, East Africa, West Africa, really beyond to Bangladesh, to Pakistan, to other countries in Asia. And to just touch on why it's so important is the access story, and especially for women. So whereas most African villages don't have a bank branch, and may be difficult for women to travel to the city to access financial services, both because of social norms of women traveling, because of household family responsibilities. Every African village today has a mobile money agent, an agent who will help load money onto a phone, as increasingly playing the role of a banker, also providing financial services. Mobile money accounts are accounts offered typically by telecoms or fintechs. They're phone-based. The money is deposited and withdrawn at typically a mobile agent, a merchant agent, and provides that access, that flexibility to provide much more affordable and accessible and convenient financial services. So what is the problem? Let's measure it. And here's the power of the data. This is a heat map showing the gender gap difference in percentage points between account ownership between men and women. So although since 2011, about 600 million women have opened accounts, and some economies have really seen inclusive growth. For example, in India, the gender gap dropped from almost 20 percentage points in 2014 to 6 percentage points in 2017. In developing countries on average, men are still 9 percentage points more likely than women to have an account. And this gap has been stuck at 9 percentage points since 2011. And what we're seeing going on, and we'll get into this into the weeds of the data in a few slides, is that mobile money offers technology-enabled accounts offer tremendous opportunities. As I mentioned, more convenient and accessible financial services, but there are barriers to mobile technology-enabled accounts that are especially challenging for women. So, for example, in countries where women don't have access to a mobile phone, they're being left behind at the starting gate. And so, just to touch on explaining the problem, why do we care about financial services? When I first started working on this topic, colleagues would say to me, "Isn't the bank account a luxury good? Why does everybody need their own Mercedes? Can't the family share an account?" And there's this growing evidence that the answer is no, that every adult should have their own place to keep their money safe outside their home. There's growing evidence from around the world that having an account allows women to make investments in both educational opportunities, business opportunities, to escape poverty, to build their financial resilience, survive economic shocks and falling into poverty in the first place. And the financial services help women increase their financial control and shift household spending priorities. When a woman, for example, gets paid directly into a bank account, she has a literal more comfortable seat at the table on how that money is spent. And a wonderful study from the Philippines shows that when women are offered bank accounts, the household is more likely to buy a washing machine or spend the money on goods that matter more for women. Two recent examples in Kenya, the spread of mobile money has been shown to lift almost roughly 1 million adults out of severe poverty and help women get jobs in business and retail. In India, moving Social Security payments into accounts reduced leakage or corruption and increased the amount of money received by beneficiaries. And when women in India received accounts linked to a jobs guarantee program directly into an account, they increased their labor force participation and earnings compared to women who received the payments in cash or in joint accounts controlled by their husbands. And so we went out and, perhaps the most important part of our data collection effort is this ability to ask the unbanked, why don't you have an account? To listen to women in developing countries who are unbanked. I've also had the pleasure myself to pilot this questionnaire in over 30 countries around the world, and we'll share with you both some photos and some stories that we've heard directly from women in developing countries. And so, first, only about 3% of unbanked women report not needing an account as the only reason for not having an account. There's tremendous nascent demand for financial services. We hear about a quarter of unbanked women saying the accounts are too expensive. That number is twice as high in Latin America, for example. In Mexico, over half of unbanked adults cite the cost as do nearly about 60% in Brazil and Peru. As an aside, this is a region that's typically has very concentrated, non-competitive banking sector with little fintech competition that has kept costs high. About a quarter of unbanked women say they use somebody else's account within their family. That's also tightly linked to countries with higher banking costs, where a woman who may not have her own salary, the household won't spend additional money on the additional account. In Turkey, 2/3 of unbanked women say they use another family member's account. And then about 20% of unbanked women say the banks are too far away or they don't have necessary documents. They don't have ID. And again, here is where we're starting to see fintech-enabled accounts addressing some of these concerns. And so that's me on the right. We haven't had the pleasure to meet. This was piloting the questionnaire, for example, in Kenya. And so, as I mentioned earlier, it's really important to remember that the gender gap hasn't changed since 2011. And here on the left are a series of countries showing this gap in 2017. Certainly Bangladesh, Morocco, Pakistan, Turkey standing out. And so there are some economies that have seen inclusive growth. I mentioned earlier India. In Indonesia, there's never been a gender gap. Women actually are more likely to have an account than men, in part to receive remittance payments from men who work both overseas and elsewhere in the country. But in other countries, we've seen this gender gap deepening. As I mentioned, in Bangladesh, where we saw a surge in mobile money account ownership by men and almost none by women, the spread increased. In Algeria and Pakistan, we're seeing a similar pattern. I also just want to mention that these gaps that I'll talk about are not only exclusive to developing countries. Now, here's a series of G20 countries where we ask questions on credit, on savings, and this is on housing finance. Do you have a housing finance loan in your name? And what's really important about that is, at least in high-income G20 countries, the financing is often linked to the deed, to having the asset in your name. Having an asset in your own name is critical to have collateral if you want to start a business or to borrow for other investment purposes. And here too, even among the G20 countries, we see women at a disadvantage, women less likely to have a mortgage in their own name or property in their own name. I also want to just, showing the data, displaying the data in a slightly different way. The countries have goals of reaching universal financial access, or at least tipping this point of having, at least half of adults in the country financially included. And let's just take a step back. We define financial inclusion as having an account, either at a bank or a mobile money service provider. We define an account as somewhere safe you can keep your money, to store money, and to be able to send and receive electronic payments to that account. And it must fit both definitions. So for example, there's some MFIs, microfinance institutions, which only offer credit and with accounts linked to it, but can't be used to send or receive money. That wouldn't count as a person being financially included. Similarly, some payment cards allow for payments, but don't allow you to store value. And so, our goal is to get every adult an account that they can use to keep their money safe and to safely send and receive money. So the figure here is showing a number of countries. In Morocco, shown here is a great example, where men between 2014, 2017, there's a surge in account ownership by men. Over half of men in the country have an account, yet because the account ownership of women is still single digit, countries will not achieve their financial inclusion goals unless there is inclusive growth. So here's a photo I took about 2 years ago in Calcutta, in a slum in Calcutta, where we're interviewing a family. We tend to travel to understand the mysteries in the data. Financial patterns that seem, mysteries to us sitting in Washington often make a lot of sense to poor adults living in developing countries. And we'll get back to this woman in a few slides. So here's an interesting part of the puzzle, which I think is often underplayed, which is that we'll never reach inclusive financial inclusion, account ownership, until we start achieving gender parity in employment. That a leading driver of the disparity in account ownership and use of financial services is disparity in labor force participation. Simply, women in the workforce are less likely to be unbanked. And so let me explain to you for a moment the figures here. If you look at between men and women, of those in the blue categories, wage employed or self-employed, the gap isn't as large. Where the gap is amazingly among wage employed men and women, there's no significant gender gap. However, among men and women who are out of the workforce, that includes women who are staying at home, mothers, it includes students, retired adults. There we see this tremendous and significant gap. Well, let me even show you further. In Turkey, for example, among adults in the world, where I mentioned earlier, there's a 30 percentage point gap in account ownership between men and women. Among adults in the workforce, there's no significant gender gap. Although among adults out of the workforce, 67% of men are banked, compared to about 35% of women. Furthermore, about 2/3 of all women in Turkey report being out of the workforce. And so it's having this need for an account to save your money, to save a regular cash flow, that also in part drives financial inclusion. So what are some other barriers? A big one is official ID. Globally, there's been tremendous progress in getting official ID to women. ID is necessary for know your customer, anti-money laundering, CFT requirements. To open a bank account, banks are required to ask for ID of the account owners. However, in 17 sub-Saharan African countries, less than half of all women report having a national ID. And so, for example, a quarter of unbanked adults in sub-Saharan Africa report documentation as a main barrier to account ownership, including 43% of adults in Togo, shown here on the right. In addition, the gender gap between men and women in Togo, is almost 15 percentage points. And so, bridging the gender gap in ID is key to increasing account ownership. And going back to the photo of that woman I showed earlier in Calcutta, her daughter had just gotten a job that she needed to receive her wage payment into an account. But her daughter's ID was back home in her village. And because at the time she didn't have a hard copy of the ID, she was unable to open the account. And so having digital accessible ID is really critical to expand account ownership. Okay, so what else? Certainly national laws and regulations that discriminate against women, explain differences in their use of financial services. And so here I'm looking at the World Bank's Women, Business, and the Law database, 2019 data. Oh, here it's showing trends. And what we're finding is that in developing and emerging economies where women face legal discrimination at work, choosing where to live, how marital properties are administered, on inheriting property, women are less likely than men to own an account. And again, there's this correlation between overall economic and societal empowerment and financial empowerment, financial inclusion. And it's also simply when women are more likely, when women control more household financial decisions, they're more likely to have an account where to keep the money. And so, and I hope I'm not contradicting myself. So it absolutely works in both directions. What we believe is by helping a woman get an account to save money, have greater privacy and control over that money, it makes it easier for her to invest in educational and business opportunities. At the same time, expanding women's labor force opportunities will also, and reforming legal reforms that give women access to inheritance, access to other capital, will increase their demand to use an account. Another interesting barrier is financial literacy. We see globally that women trail men. With funding from the S&P Foundation, we added to the Findex data in 2014 a series of questions on very, very basic questions on understanding of concepts like interest compounding, inflation, and discounting. And what we find here, what this figure is showing, I apologize, I'm missing the bottom axis, is that, so the darkly shaded are people who can answer one of two very basic questions on compound interest. The pale color are those who could not answer these questions. And what this is showing is that even in high income countries, a large number of women who have credit outstanding can't answer basic questions of interest compounding, suggesting that these women are more vulnerable to financial abuse and proprietary lending. We also, and here's just, this is also a very nice example of the impact of women having lower financial capability. This was a study done by Alan Gelb and others. So in Bangladesh, the government switched from cash to digitally dispersing education subsidies. And as shown, the figure on the left, most women were very happy with this. But about 15% of women said they were actually worse off. And who were they? These were the women who were literally, lower literacy, lower numeracy, that couldn't understand how to withdraw the money themselves and had to ask somebody else to withdraw it for them, which both potentially, someone took a cut of their money, and or they lost control over that money. And so, it's really important when we'll talk about it in a little bit about when you design new payment programs to make sure that women have the capability and confidence to use the products themselves. And this is a great example of jumping into the linkage, the urgency that COVID has given to this agenda. The World Bank has documented over 1,000 social transfer payments in over 195 countries to address COVID relief payments. And many of them are paying digitally, many times for the first time. And so what we're seeing is that women across Asia, across Africa, the very first time receiving a COVID relief payment into an account. And so it's really important at this point to make sure they have the financial capability and confidence to use the account themselves. And then another, as I alluded to earlier, a huge barrier is mobile phone ownership. We also have data on the percentage of adults who have their own phone. In India, men are 15 percentage points more likely than women to have a phone, and 20 percentage points more likely to say they have access to an internet connection. Similar in Nigeria. As I said earlier, these sorts of gaps are leaving women behind at the starting gate. They don't have access to their own phone. They can't have control over their own money and their own mobile money account. And it goes even beyond phone ownership. In Bangladesh, for example, where I've been working, the biggest challenge to payments made directly to mobile phones is cashing them out. In order to cash out your money, you go to a mobile phone agent, you give them your phone number to activate the account, and social norms make it very challenging for women to give a strange man their phone number. And so as a result, women often are uncomfortable going into the mobile agent themselves, and therefore asking brothers or fathers to withdraw money for them. And again, it's a way of they're losing control over their money. And so here's a photo I took in Cote d'Ivoire. Let's get into the more prescriptive on how digital payments can help narrow the gender gap. And this is perhaps this is an exciting side of looking at, where are the opportunities for us to expand financial inclusion using technology. And so let me start with, digital payments, the ways that digital payments can help women build resilience. And so, just to summarize, it gives women greater privacy, security, and control over their money. From the sender's perspective, for example, governments, employers, we know there's more transparency, lower leakage between the sender and receiver. There's been work even in the US showing that it's interesting with the Kansas City, Missouri versus Kansas City. When Kansas digitized social payments, there's a reduction in crime compared to Missouri that continued to pay in cash. It also helps, this is a first entry point into the formal financial system. It also helps build a payment history. Increasingly, especially, so to access credit requires typically collateral. Women typically have less physical collateral than men, less likely to own their home, as we discussed, less likely to have other car or other assets. However, increasingly creditors are using reputational collateral, using artificial intelligence and other ways, even just simple payment history. So a woman showing that she receives a wage payment to her account, to her phone, or an informal vendor who shows that she's receiving, 100 rupees every day paid directly to her phone. That's a payment history that creditors increasingly are using to extend credit. And so what we're finding is that fintech offers tremendous opportunities. And so we see that about over 600 million unbanked women report having their own mobile phone. Certainly there are gaps, such as in Pakistan, where there's a tremendous gender gap in phone ownership. We still see about 30% of unbanked women having a phone. And this is, I would say the lower hanging fruit. And so although there are greater challenges to opening a bank account, especially around access and ID, a mobile money account might be a more appropriate option for these women. And we've seen that, it's a proven track record of digital payments being a way to expand financial inclusion. So globally, we ask questions in Findex about why you opened your first account. Globally, about 10% of adults open their first account to receive a digital payment, a wage payment, a government transfer payment, or a payment for the sale of agricultural products. And to put this again through the lens of COVID-19, as I mentioned, governments are increasingly making COVID payments directly into accounts. In addition, employers are rapidly digitizing payments to workers into accounts. Cash can be unsanitary, waiting online can violate social distancing requirements. And so paying workers into an account is much more feasible during the COVID period. So we need to be careful about it. So on the one hand, this creates incredible opportunities to bank and bring large numbers of women in developing countries into the formal financial system. On the other hand, we need to ensure that there is a consumer protection in place, in the strong and enforced consumer protection to make sure the women understand how to use their accounts as well. And so, we see here about 20% of banked women in Egypt and in Thailand open their first account in order to receive a payment. So let me get into some specific use cases, starting with savings. So about 85 million unbanked women save semi-formally. What does this mean? So this is, for example, and this was one of the great mysteries in our data. In 2014, we saw that about a third of women in Ghana had a bank account, but yet saved using a susu. So you may think of in Africa, they have Raska's community savings groups where people contribute $1 or $2 a week, and then on a rotating basis, get the pot of money. Someone in Nigeria said, I belong to 3 community savings groups because I assume the first 2 will steal my money. These are kept under the mattress in one of the women's homes, not necessarily safe, not earning interest, and not helping women build that relationship with the financial institution, especially to receive credit if she needs so in an emergency or for an investment. In West Africa, they have what they call susus, which are a guy on a moped who comes around and takes $1 a day and gives it back to you at the end of the month. And so this is a really expensive form of savings. The women are losing a full day of savings. But the reason they do it is that, so we went to West Africa and we asked women, you have a bank account. Why are you losing money saving every day? And the response that we got from them was, I can't keep $1 in my home one night without that money being taken or borrowed by another family member, typically a male family member. I need to get it out of my home. And it doesn't make sense for me to take a bus every day across the city to wait online to deposit $1 into the bank. Banks aren't designed for that high frequency, low denomination transactions that these women want to make. And so they were using these expensive susus. What was really exciting was in 2017, there was a surge in mobile money accounts in Ghana. And then we saw in the data that there seems to be a substitution from saving using susus to saving using a mobile money account, where the woman can go at the end of the day to a merchant next door to her home, deposit that $1 using a mobile money agent, whether it be a standalone agent or a merchant, and save in a safe, liquid way. And so what technology is enabling, again, going back to that phrase, low-income women tend to make these high-frequency, low-denomination payments. So they're buying food every day because they don't have enough money to buy for the week. They're making, the most important payment is to oneself. They're trying to save just $1 or $2 a day, or they're frequently receiving money from a family member in a different part of the country. And so all these transactions, technology is enabling more affordable and convenient payments. And so this map is showing the size of the orange bubble are the number of adults in millions who who are unbanked but yet are reporting being able to put money aside every month, albeit in an informal way. And so increasingly there are MFIs and others looking to formalize this, to mimic the group, the collegial aspects of informal savings groups, but moving the money into, for example, a mobile money account in order to build that financial relationship. And so the numbers here, for example, there are about 35 million unbanked women in sub-Saharan Africa who are committing to saving every month, but doing so informally. So here's again what's directly related to the COVID pandemic. So we see about 55 million unbanked women who are receiving their government payments in cash. So here's an action the government can take. So for example, 20% of unbanked women in the Philippines are receiving these cash payments. for the government to take the lead and digitize their own payments is a way of bringing many women into the formal financial sector. Today, this number, I would expect, we're collecting the next round of data, will explode as around the world, sadly, with unemployment growing, greater number of adults needing financial support, with countries rushing to offer support payments to ward off food insecurity, hunger, and evictions. There's going to be even greater opportunities both to digitize those payments as well as help those adults getting an account for the first time, use them also for savings and to build credit histories for appropriate credit. So the next topic is also, we also look at how people are paid private wages. So this is a photo I took. I've been involved in a multi-year study in Bangladesh with the garment factories. And so interestingly, this work is being driven by the large brands, think Gap, Marks and Spencer, who increasingly want their suppliers to pay their workers electronically because they wanted that electronic trail of fair wages. From the factory's perspective, we also went and did a business case study and showed that the cost of paying cash is really expensive. We had a guy stand up at one of our launch events and saying how every month he drives the equivalent of $4 million in Mack trucks out to a rural area where he has to close his production factory for up to 4 days to dole out cash. And he's paying wages in 500 taka notes, which is effectively $5 bills. It's inefficient. And again, in the days of COVID, it's unsanitary and violates social distancing. And so with this factory in Bangladesh, we helped them roll out electronic wages. So there was a sample of workers, random sample, who were paid for the first time into a new account at a bank or mobile money provider, and then a sample of workers who continue to be paid in cash. We tracked them for about 18 months. We found that the workers paid into their account nearly doubled their savings and became better at meeting their end of month shocks and dealing with various emergencies. We also found intriguingly that workers paid into mobile money accounts, they started sending money back home from their phone directly without using an agent. And we saw spillover effects in neighborhoods with factories that had an account, that were paying electronic wages into mobile phones. The agents were less likely to ask for extra fees from the woman. In other words, the experience of, it was learning by doing, the experience of being paid into an account made these women savvier financial customers. And so again, the heat map, is showing these enormous numbers. And of course, not all private sector employees work for global value chains or large formal sector employers, but increasingly they are. And there's still tremendous opportunities. And even, furthermore, that 75% of unbanked receiving private sector wages in cash have their own phone, enabling both payments to bank accounts as well as fintech accounts. Here's also some new work we're doing in Sri Lanka with the tea sector. Here was kind of wild. If you see the photo in the middle, the woman on the left plucks tea all day. This is a twining factory in their supply chain. The man in the middle is weighing her tea a couple of times a day using a Bluetooth-enabled scale. And so there's, real-time, accurate information. And the question here again is, how can we digitize her wages? Even more so, looking at farmers, small shareholders around the world who sell, you think of all the large global value chains, coffee, tea, cocoa, about 13 million unbanked women in Ethiopia, many of whom are growing tea and other products for global agribusiness chains, are being paid in cash. Digitizing the payments to farmers offers tremendous opportunities. In Kenya, Tanzania, and Uganda, for example, about 10% of all adults are farmers who are now being paid directly into the bank account for their sale of agricultural products. And we know that farmers are potentially the most people who have the most need for formal financial services. Their income is lumpy. They may get paid at the end of the season, and they need to stretch that money all the way to next season. But yet they need to pay daily for food, monthly school fees, and they have to have money saved to invest in seeds for the next harvest. And so paying the farmers into an account builds this financial relationship, which they can leverage for a whole host of other financial services that they need. So really the highlights. This is a woman we talked to in India. So next we're going to talk about digital bill payment. And again, people's first reaction is, oh, it's convenient that I have auto payment, but really is this a development issue? And the answer is yes. So this woman lives, I would say by Indian standards, peri-urban. She lives right outside of, about 2 hours outside of Mumbai, and she a farmer. And every month she spends 50 rupees to take a bus to the city to pay a 300 rupee electric bill, which makes no sense, right? And so it's very costly for her. It's costly. The bus fare is costly. In addition, her monetized time that she loses income. And so digitizing payments is far more than a convenience for women in developing countries. We speak to factories around the world who tell us their workers garnish wages for a day a month to run around town paying school fees and other bills, which can easily be paid by phone. And so the color here switches to blue because here we're looking at banked adults and opportunities for them to increase their usage of their account. And so, in India and China alone, there are hundreds of millions of adults who are still continuing to pay utility bills in cash. Finally, talk a little bit about digital merchant payments, also far more than just a convenience. This is a woman we met also in India who had a little shop, and she had just started her first Amazon shop. This is a relatively lives in a lower income community. And she was, so let me jump a slide. What's interesting is that online, in 2014, we asked people, do you shop online? And I very naively called that e-commerce. What we discovered when we went out to the field was that most people actually pay cash on delivery. And so what you're seeing here is the blue bar, only the blue bar are people who are paying online for purchases online. So in Vietnam, for example, less than 5% of adults who make a purchase online actually pay for it online. And so why is that a problem? So as this woman was telling us, she can't restock her inventory for up to 5 days. If she sells something online on Monday, she can't restock her inventory until she receives the money, the cash on delivery, to restock her inventory. And so digitizing merchant payment, which involves building trust in the seller that they'll receive their money, trust in the buyer that will receive the goods, is really critical, and making this all affordable and supportive ecosystem is really critical to support e-commerce. And coming out of COVID, where both women have suffered job losses in greater numbers than men, as social distancing, unfortunately, might be a requirement for some time, but tremendous e-commerce opportunities for women. E-commerce is also often, I've worked with women in entrepreneurship associations in the Middle East, where women are selling online because it's harder for them to have jobs in their own countries. And so e-commerce offers tremendous opportunities for women, if online digital payment ecosystems work. Okay, if I have a few minutes, I'm just checking the time. I'd just like to take 1 minute to talk about some of the bigger relationships on reforms. So what's interesting here is this is a relationship between account ownership and GDP per capita. And the yellow bar is showing us so that below median GDP per capita, developing countries, there's no relationship whatsoever between, so although the relationship is about 0.7, if you look at it globally, that relationship falls to 0.36 for economies below median GDP per capita. And so, it's almost a vertical line. And what's interesting and important here is this is where regulations start to matter. And this is where the introduction of allowing fintech competition, allowing relaxed, tiered, know your customer ID requirements, and other policies start to matter. And so I'll just take a moment. And so if you want to start to think about, who are these outliers and how did they get there? Well, okay, so number one, Mongolia. Mongolia introduced child accounts 20 years ago, which means every baby born in the country, as someone said to me, you call your bank before you call your mother to let them know you've had a baby. you get a few dollars put into a bank account. And so bank account ownership is over 90%. And we really see people who grew up seeing a bank account with small amounts of money grow over time, continuing to use their accounts as adults to save and for other transactions. Number two, what's going on? So this is, the two dots with a similar story. First, Thailand, where you see growth in debit card use, and you also see you saw massive digitization of private wages, which got accounts into the hands of most of the formal labor force. You also see China, which has seen a tremendous surge in the use of WhatsApp payments and other QT-enabled payments in the country. Three, you see Ghana. I mentioned earlier, a surge in mobile money, over 30% point increase in account ownership due to mobile money. And then who are the stragglers? Oops, sorry. So 4 is Mexico, 5 is Morocco, 6 is Pakistan. Countries, certainly Pakistan and Morocco, which have really left women behind. And so I will open it up to discussion. How digital payments can help COVID-19. To summarize, it's really brought urgency to the agenda, especially for women who have suffered greater losses, who are more in need of social transfer payments, and the importance of getting the money into the hands of women directly, and the tremendous opportunities to do that via digital payments. So all of our data is publicly available on the micro level and the country level on our website. I'm happy to answer any questions.
Thank you so much, Leora. That was really fascinating. And I think what we probably all appreciated was the fact that you took a subject that seems very abstract and made it very concrete and real in a global sense. If I could just kick off the discussion, one thing that I took away from your presentation is that despite the influences of more slowly changing factors like culture and social structure and so on, that there's a real opportunity to improve financial inclusion through more innovation-friendly regulation. And what is the barrier to governments realizing that and actually implementing policies that would support fintech and inclusion?
So there are some countries with very strong banking sectors who don't want the competition of fintechs. That certainly has influenced potentially policy in some countries. And other countries that have really taken brave measures, India, for example, required banks to offer what's called a JDY, Jan Dan, simple, no fee, no minimum balance accounts, and incentivize banks with the goal of getting an account into every citizen's hands. And we saw a surge. I mean, really the success of the program, over 300 million accounts were opened. India literally won the Guinness Book of World Records for opening the most accounts in a month. But yet that's an interesting example, because according to Findex and other sources, over half of all accounts are completely inactive, haven't had a single deposit or withdrawal. So policies need to be the policy can't stop at opening account. The policies need to incentivize also usage. And again, India is an interesting example of using the accounts to receive government payments. And as we discussed, is a really important way for governments to decrease leakage and make sure that money gets into the hands of the intended recipients.
If you don't mind, I'd like to ask a question about another South Asian country, Bangladesh, where you've been doing a lot of work. And as you were describing the substantial gender gap in financial inclusion in Bangladesh, I was thinking about Grameen Bank and wondering what Grameen Bank does in this sphere, whether they've been an innovator or what you can tell us about them.
So Grameen Bank has absolutely been transformative to many poor women in Bangladesh. but many of the accounts don't offer community are more community savings based and might not offer formal accounts that can be used, for example, to send and receive electronic payments. What we are seeing, though, in Bangladesh, is bKash and other DBL and other players offering accounts based on phones that are allowing women, even in rural areas, to access financial services.
Okay.
Although, as I mentioned, one of the challenges in Bangladesh is simply we need female mobile money agents to make women feel more comfortable using their accounts.
So we have a question from Jerry Caprio, who compliments your talk and also asks, what are recommended minimum ID requirements for fintech accounts, balancing access and prudence? That's a big question.
May I say that so that question is beyond the scope of the few minutes that I have here. No, but certainly there, and what's interesting that during COVID-19, we've actually seen a few African countries relax identification requirements on small accounts. But the idea being, so accounts that have maximum balances, maximum number of transactions per month, and are less of a money laundering, terrorist financing risk, having relaxed tiered ID requirements. And so that's something that's been introduced during COVID, which I would suspect would continue to allow greater access to accounts, especially to receive various social transfer payments.
Thank you. Question from actually my colleague, Brenda Samaniego. When government transfers were first directed towards women in the household, one concern was the indirect effects these gender transfers could have on domestic violence. Do you have a sense of whether that is still a concern with fintech accounts?
No, great question. And it's something we're very aware of and concerned about. And every study that's looked at the introduction of formal financial services has tracked gender violence. The good news is no one has found a positive impact. And the hypothesis being if the money is now in a woman's card or phone, will the husband try to beat her to access the PIN number, et cetera. The less good news is we don't have any evidence that it reduces domestic violence, which is really the goal. And there are a lot of us thinking about how can formal financial services help reduce domestic violence. Beyond what we have, there is some evidence that women are better able to leave violent situations and relationships when they build financial capital. I'll make something in Bangladesh. So these women in the factory who are now being paid into their account, we went to debrief them. This woman said to us, my mother-in-law waited outside the gate for me on payday. Now she can't. That these women really very quickly became aware of the greater control they had over their household finances by the money not being in cash. That they were now, and what we see in our data, the women have a greater partaking in the household family decision-making after having their own account to receive and save money.
Thank you. Actually, if I could jump in with another question. One thing that really struck me towards the end of your talk was your comments on merchant payments. And what really struck me was that there's a very large literature in economics now about micro-entrepreneurship and so on. But a lot of that literature is not really focused on the financial piece of that. And this is true for many small firms that, cash flow becomes a problem if you don't have access to finance when you need it. And certainly getting paid by customers with a delay could be very critical. So is there more attention being paid to that?
Yeah, and again, during COVID, helping businesses survive online. Certainly I actually have new work in collaboration with MasterCard, with Sumit Agrawal and others, where we look at the impact of a natural disaster on spending. And seeing the importance of being able to shift to online sales to maintain, your sales volumes and your income. And so even on the micro enterprise side, certainly for Indonesia, for example, the surge in food delivery services. Previously, women who cooked in their home and their brothers and sons would deliver the food around the city. They're now app-based drivers who will come and pick up and deliver the food for you, which makes you get paid in advance. It reduces the need to deal in cash during social distancing days, and expands their marketing and their sales. So my point is that we are seeing a shift. We are seeing movement of micro enterprises as well, being able to take advantage of e-commerce opportunities.
Thank you. There isn't another audience question, so perhaps this is a topic that obviously I'm very interested in, and so maybe I can just pose another question, slightly different from the focus on the developing world, and the question is: are there any lessons from the experience of developing countries for the United States?
Great question. Certainly our settlement system would be nice to quicken that, so that poor adults get the money they need. I've been interested in, for example, unemployment benefits. There are still a number of states that pay them in check. If you get your check on Friday with 3-day settlement and you want to take your girlfriend out for dinner Friday night, you'll end up in a check casher paying really high fees, and your bank account might be closed for inactive use after a few months. So absolutely, the U.S. digitizing all payments is a lofty goal.
Is that a regulatory issue in the United States? Is that another example of kind of regulators not keeping up with technology?
I'm not familiar enough.
Okay. Sorry.
Apologies. These days I know much more about South Asia than I do about you.
Well, let me ask about South Asia. I mean, my impression of the Reserve Bank of India has been that they've been very slow to enable fintech type innovations across the board.
Well, there has been regulatory reform, and now the question is implementation and take-up. I know you have to be cautious in terms of what you say, and certainly we realize these are your personal views and not those of the bank, obviously. So. And I know I threw a lot of information out there today, just trying to tell you. I gave really the bird's eye view of all the data, and we have a lot of reports and more detailed analysis on our website.
And as I understand it, actually, this Findex database is freely available. It's a public resource. Is that correct?
Public good. Yeah, all the micro data for all 150,000 adults is available in Stata, our micro data library.
Earlier in the series, as you know, we had a talk by Ratna Sahai of the IMF, and she presented also some data. Are they using the same database, or do they have other sources of data, or do you happen to know?
Yeah, for her fintech work, they are using Findex data, although they interestingly make different choices on definitions. For example, they exclude credit cards from their measure of digital payments, whereas we consider that a key mode of digital payments. And especially, there's regional variation. For example, in Latin America, it tends to be a more POS heavy region, which actually might explain why there's been less dramatic growth than we've seen in East Asia, which tends to be a mobile app, QR-based payment system, or Sub-Saharan Africa, which is more mobile money, telecom-led innovation.
So this is a complicated new world where you have tech companies like Facebook and intermediaries like MasterCard, which were not necessarily tech companies, and then and then you have a lot of fintech startups. Are traditional banks kind of taking part in this in developing countries, or are they just ignoring it, or are they trying to stop it?
And I always say, don't write off the dinosaurs so fast. No, absolutely. And in many regions, for example, in China, WhatsApp users are required to have a bank account on the back end. There's also really nice, I think, innovations happening in Africa. For example, we're working in Ghana. There's a lot of work in Kenya to sweep money, really effortlessly and costlessly from a mobile money account into a bank account. And so, in effect, the banks should be leveraging mobile money accounts as their distribution network. The same stories I told earlier, how large banks in Africa don't have the rural footprint, but there is a mobile money footprint. So the mobile money agents are the ones collecting the money into these mobile money accounts. There are transaction accounts used for all sorts of P2P and some merchant payments. But then people can sweep their money from their phone into a bank account in order to potentially earn interest and develop that relationship to access credit.
So that would be not a bank account, but a separate account which is somehow linked to a bank account.
No, proper bank. So okay. It's just allowing and when you ask about policy reforms, interoperability is really a key regulatory feature. So it's interoperability both between mobile money companies. So you don't need to have 4 SIMs cards to send money to a friend with a different mobile money account, and interoperability between banks and mobile money services. So you can, using your phones, move money from a mobile money account into a bank account.
So this sounds to me like an area where there is some organizational inertia among traditional banks, and they could potentially do more to reach out to their customers in using this new technology.
Yeah, in countries with regulations supporting interoperability, you are seeing many banks try to take advantage of the opportunities by often partnering with mobile money providers.
Okay. Yeah, no, it's such a huge topic, and there's so many different technological and regulatory pieces. And what really struck me today was, at least from my perspective, the importance of the making things easier for small businesses and micro enterprises. I mean, often we focus on the consumer side, but at many developing countries, a lot of employment is through this sort of micro enterprise.
Yeah, and I would consider farmers, small shareholders in global value chains very much a small business, and so the efforts and often being led by some of the large agribusiness supply chains, like Unilever, to digitize those payments is a really important way to bring those farmers into the formal financial sector and provide them with the financial services they need.
Well, thank you so much. I think this is one of the most important and exciting areas of development, economic development, and I think the COVID crisis has highlighted the importance of doing this and getting it right. And we're very grateful to you for making time for us. And I know the next week is a holiday week, and so we're very appreciative. I'd just like to thank the audience and remind everybody we won't have a talk next week because it is Thanksgiving. I'd like to wish everybody a happy Thanksgiving. And our final talk of the series will be in 2 weeks. We'll have a Barry Eichengreen speaking on emerging markets. So thank you again to everyone. Thank you, Dr. Klapper, and wish everyone a happy Thanksgiving.
Thank you. Bye.
Bye-bye.